I'm the master of illusion, minister of sin, two-faced snake, wicked shiny skin. I will forsake you, destroy and unmake you. With all my might, I will take you down.
And that is basically what every single bad guy who helped cause the financial crisis of 2007 and 2008 was thinking about us. Maybe not actually thinking that, but their underlying intentions were basically that. They didn't give a shit about anybody in the public. They only cared about themselves. And, well, as we'll see when we talk about this, that it's not just the evil, greedy bankers and the financial institutions and Wall Street that was bad. I mean, they were bad. They behaved very, very badly. But there were a line of very perverse incentives lined up for them to engage in said behavior in the first place. So what we'll see is that ultimately no one's really super guilty. Nobody's really super innocent, at least relative to anybody else, as far as most of these players in this crisis are concerned. Now, this is titled Financial Crisis of 07-08, What Were the Causes and Policy Responses to the Worst Economic Crisis Since the Great Depression? This is, of course, before, or this presentation was made before the COVID-19 outbreak basically completely wrecked the global economy. I guarantee you when more data gets released, we will see this is actually worse than the financial crisis. Currently, unemployment numbers are way worse than what we had during the financial crisis. Let's just hope that it's a little bit more short-lived than what we saw during the financial crisis, because as we'll see in a minute, unemployment spiked, it got really, really high, and the recovery was incredibly slow. So, with all that said, let's get started, shall we? Yeah! So, let's look. We can see real GDP fell about 4.5% over the course of the Great Recession, and the Personal Consumption Expenditures Price Index fell by 1.5%. That was not good. That was supremely not good. Output and prices are both falling. Take a wild guess what kind of a shock that is. Now, unemployment spiked at actually a little bit over 10%, and the S&P 500 stock price index lost half of its value over the course of the recession. Really, really, really bad numbers. These are terrible. So let's get to the cause of all this stuff. Because do you ever feel like all the stuff behind what caused the crisis is just too much? Like there's just too much information and everybody's basically just going, don't worry about it. It's just, it's too complicated. There's no point in trying to learn about it because all the stuff that happened was just crazy and there's all this weird shit going on and, well, it's all just too complicated. It's over your head. So maybe, feel like things get too technical too fast. Well, if you do, you're not alone because that's how I felt when I was going through this. And just to give you an estimate as to what my age is, I was in my third year of college when the financial crisis really came to a peak, when things got really bad. And I was an economics major at the time, and I still had no idea what was going on. So, honestly, I wouldn't be surprised if you thought clowns like this had something to do with the financial crisis, because I certainly did, that it's like this. Yeah, yes, I know that, Sydney. Everybody knows that. But look, 4 wrongs squared minus 2 wrongs to the 4th power divided by this formula do make a right. Well, if you feel like it's just all this weird technical shit and a bunch of weird mathy science nerd dude people, not just dudes, dudettes too, that are figuring this stuff out, well, if you think that, I can't blame you because that's how I felt. So this is what we're going to talk about. We're going to talk about what I learned about the financial crisis, and then I'm going to share what I learned with you so that you can learn something about the financial crisis too. First, what led up to it, what caused it. Then we're going to talk about once the financial crisis really came to a head, once it had manifested itself in the economy and the bubble burst, we're going to talk about how it affected the economy, and we're also going to talk about the ways that it affected the economy that people that saw this crash coming, because believe it or not, a lot of people actually did see it coming, but they didn't think it was going to be as bad as it was. So we're going to talk about why. We're going to talk about why some of these guys didn't think it was that bad. We're going to talk about what policymakers did to try to rectify the situation. We're going to talk about what the effects of these policy interventions were, And of course, more. All this and more will be answered in this lecture. So, what got us into this whole mess? Well, we've all heard stuff like, mortgage-backed securities, collateralized debt obligations, credit default swaps, and all sorts of other weird financial derivatives that just sound like buzzwords until you figure out what they actually are. So, is that all? Well, not really, because there were, aside from just these things, because these are just things, right? These are different types of financial instruments that were used, that were sold throughout the market in order to try to get some companies to generate profit. And there's nothing wrong with generating profit, because profit is ultimately a signal to other firms to come in and try to compete, drive prices down. Profit is ultimately a signal as well as a motive for innovation within the economy. So having profit is actually a really, really good thing to go for. But it wasn't these things that caused it. It was really what bad things people did using these things to take advantage of the situation. And if you want to know who was the worst about it, well, yeah, you guessed it. Rian Johnson, director of the worst Star Wars movie ever made. Thanks, Rian Johnson. So, when we're going to go through this, it's probably going to be beneficial to quote Albert Einstein because, well, I mean, okay, maybe he wasn't alive at the time, but he might have said something that could maybe help us, like everything should be as simple as possible, if not simpler. Okay, I'm willing to admit that he didn't say that. That dude is so heavily misquoted, he's probably rolling over in his grave. Although I would imagine Abe Lincoln's probably rolling over more because you can't ever forget that one quote from Abe Lincoln that said, "Don't believe everything you read on the internet." But anyways, let's keep it simple because it all really, this whole thing, everything that led to this boils down to one main cause. So give us a drum roll. You can do it on your desk or your laptop or your lap or your bed. I don't care. Just do a little drum roll. Risk. Oh, shit. Not that kind of risk. Not the game. The actual risk. Oops, my bad. So, risky lending and borrowing, confounded by lax regulation, as well as extreme difficulty in being able to rate the creditworthiness of these risky assets, all led up to moral hazard and adverse selection. Everything else that happened stems from this. Now, like I said before, nobody was totally innocent. Nobody was totally guilty. Actually, okay, maybe some people were totally guilty. Guys like Bernie Madoff, because, if he had gotten his way, he would have made off with all your money. Well, I thought it was funny. Come on, somebody, I hope somebody's laughing. Now, granted, I can't hear you laugh because, well, e-learning and shit like that. But let's try to take a different approach to understanding this. Let's try to actually take the approach that we've been following throughout the entire semester. Think about it like a movie. So for a good movie, well, as I've said before, we need interesting, believably motivated characters. This would be the optimization principle of economics. This is where everybody simultaneously optimizes. Once we have these awesome characters that are defined, that have interesting objective functions in our case, we need an engaging plot with good conflict and hopefully decent resolution at the end. This would be the equilibrium principle that we've talked about before. And then, of course, we get done making our movie, we send it off to the critics, and they're going to tell us if it's worth watching, assuming they're not being paid off by Disney to give the new Star Wars Skywalker Saga movies a good review. And in case you ever wondered which of my videos here on YouTube would ever run the risk of being demonetized, although I don't know how enough people would ever watch my videos to get them monetized in the first place, but if you ever wondered which of my videos would get demonetized, this is probably going to be one of them. Anyways, releasing this shit to those overpaid hacks that sit here and tell us whether or not we need to go see movies would be the principle of empirical analysis. That's where people take the model to real-world data, test it, see how it works. So let's talk about the optimization part of this. We need characters to make the story a good one. So, okay, let's start with households and consumers because they were definitely players in this story. But we also had banks and financial institutions. They played a serious role in this, as I'm sure everybody knows by this point. But there were some other players. There was the federal government, Fannie Mae, Freddie Mac. They weren't exactly behaving very well. The Federal Reserve Bank was kind of sort of behaving well, but as we'll see, they weren't exactly 100% on the ball with what happened here. But we also had ratings agencies. Ratings agencies played a huge role in this, and they weren't exactly part of the financial institutions. What they were doing is they were just rating a lot of these financial instruments that were being sold on the market to let people know, okay, are they creditworthy? How risky are they? Stuff like that. So when we're describing the players, let's talk about what they wanted to do. So the households, we'll call them people here, wanted to borrow the necessary funds to purchase a house. So a commercial bank would lend money to them, and that loan is what's known as a mortgage. Investment banks would then swoop in and they'd buy these mortgages in large quantities from the commercial banks. What they would do afterwards, once they bought all of them, they'd bundle them into a security, because when it comes to selling this stuff in the financial markets, well, if you're selling each individual mortgage, that's a lot of shit you got to sell and keep track of. So why not just bundle it up into something smaller and sell it for a massive amount of money? Now, it doesn't have to be sold to just one person. It could be sold to multiple people. So shares of this security could be sold to multiple people. And this is what was known as a mortgage-backed security. And these guys were wildly popular because mortgages were considered to be low risk. I know, haha. Housing prices were going up. So this really just meant higher returns for investors, because if mortgages are low risk and housing prices are going up, well, any defaults on these mortgages could easily be covered by these investors, because if housing prices are going up and somebody defaults and they get booted out of the house, well, that house is just going to be sold at a higher price. So even if they do default, hey, fuck them, who cares? Because, well, does it matter? No, we're just going to get more money from this in the future. So commercial banks knew this. So they wanted to lend out more, because the more they would lend out, the more these investment banks would come in and buy up these mortgages from them. So they made the loan, investment bank comes in, buys the mortgage, the commercial bank no longer has to bear that risk. Now, the rise in popularity in the mortgage-backed securities led to moral hazard. Now, moral hazard is one of two big issues in the game theory literature that show up here. I know, I'm sorry to be exposing you guys to game theory. It does suck. Moral hazard you could think of as a hidden action. So if there is some behavior or set of behaviors you can choose from, and the choice that you make over that behavior is going to be determined by the cost that you have to bear to engage in that behavior. If that cost is removed, then you're going to engage in bad behavior. And that is what's known as moral hazard. A good way to think of moral hazard is if you go to the grocery store to get some stuff and you have to pay with your debit card, well, you're probably going to get like really shitty ground beef. If you want to drink some beer, assuming everybody here is 21, you're going to be drinking like, I don't know, PBR or Natty Light. I think both of them are headaches in a can, but that's what you would probably be getting because, well, let's be honest. We're all college students, and we don't really have a whole lot of money. So assume you go to the same grocery store, and you want to get some groceries, but now you've got Mom's debit card. You went to the National Bank of Mom. And the National Bank of Mom goes, here's a debit card. Go buy some groceries. And you're like, thanks, Mom. And then, well, you're probably not going to get shitty ground beef and PBR or Natty. You're probably going to get, like, a ribeye. If you're like me, filet mignon, because, God, fillets are delicious. Anyways, getting off topic. And you're probably going to get, like, instead of cheap beer, you're going to get good beer. I don't know what your beer preferences are, if you even like beer. My beer preferences are like, the Sam Adams cherry wheat. That's really good. Of course, if you're 21. If you're not 21, then, maybe you, instead of getting like Sam's Cola, you actually get like Coca-Cola. So either way, there's a hidden action going on because all of a sudden you don't have to bear the cost of certain actions. They're being put onto somebody else. In this case, these commercial banks issuing the mortgages didn't have to bear the risk of default, so they didn't really care that much. So they'd lower their lending standards just to make more loans. So a lot of banks ultimately weren't doing their homework on these households because, again, they didn't care. Because all they were going to do was just turn around and sell this mortgage, whether it was a good or bad mortgage, to the financial institution. Basically, just let somebody else handle it. So because they weren't doing their homework on these households, that leads to adverse selection, which is it's the other part of that little two-part issue in the game theory literature that I was talking about. So I'm sorry, I just had a giant brain fart. One of my cats just walked right past me and just completely distracted me. Anyways, moral hazard is hidden action. Adverse selection, on the other hand, is hidden information. So when there's hidden information, basically that means there's some sort of a transaction going on where one person has information about whatever this transaction will be that the other person doesn't. So if you think like, lemon laws when buying a car, like it's this really crappy used car dealer and he wants to sell you this piece of shit car that looks good, but you don't know it's a piece of shit and he does. You have no idea. It's just as soon as you roll off the lot, it's going to fall apart and just explode in this giant fireball. Hopefully not killing you. Get out of the car if that happens. But if you don't know that and he does, well, that's adverse selection. There's hidden information in this transaction. The hidden information was on the part of the households here, but it's also kind of the banks, because the households, if you're trying to get a mortgage, maybe, hopefully we're all super honest here and we'll just go, hey, guess what? I don't really think I can afford a house that's like super massive. Maybe I shouldn't get a huge house. But not all these households were smart and responsible. Some of them were just really dumb. And so they were buying these houses that they could never afford. And there's a multitude of reasons for why they were doing that. It's not just because they were dumb and irresponsible. A lot of them were just horribly misled by the banks. But at the same time, banks wouldn't know if households had any risk of default, nor did they care to find out. And a lot of them actually did find out and just didn't give a shit because, well, screw it, just send it over to the investment bank. So banks didn't know, they didn't care if there's a default risk. And they would lend out even if they knew the household couldn't pay. And that was what's known as a subprime mortgage. Now, this process is what's known as predatory lending. So if this guy writes a loan for you, well, guess what? Predatory lending. Now, investment banks, on the other hand, thought the stuff was low risk because they didn't have any other information. So if a few houses defaulted, the bank would get the house, housing prices would go up, they could sell the house, recoup their short-term losses, and be okay. So if investment banks could sell these mortgage-backed securities on the market, they could stand to make a fairly substantial return. But the problem with the mortgage-backed security in its current form is that it was hard to assess which mortgages were and weren't subprime. There were a lot of institutional investors that needed to buy these assets that were given a certain rating, like, AAA, AA, etc. So, like, say, Social Security, for example. There's only a certain class of ratings of these assets that they can buy. They can't buy shitty assets because that means there's a high risk of default. And, basically, if you're managing other people's money, they're going to be kind of pissed if you horribly mismanage it. There were pension funds that were the same way. So if you talk to any of your parents about pension funds, they'll probably, if they know what's going on with this stuff, they'll tell you, okay, yeah, well, chances are these pensions are, the way that they're being invested, they can only get a certain group of ratings. And so since the risk of default was unknown, and it was definitely not zero, there was a much smaller market for these mortgage-backed securities as they currently existed. So these financial institutions needed to figure out a way to expand the market. So if these investment banks were going to find a way to expand the market, they had to find a way to assess the riskiness of these mortgage-backed securities. Meaning, they had to find a way to get ratings agencies to figure out what the creditworthiness of these instruments were. And this is where collateralized debt obligations, or CDOs, come in. So to create a CDO, what would happen is an investment bank would form a new company called a special purpose entity, or SPE. This SPE would split the mortgage-backed security into, like, say, three classes, also what's known as a tranche. So there would be three tranches here. These tranches could be sold on the market to more investors. And whose great idea was this? Because this sounds like some pretty sketchy shit. So we got to know, okay, whose idea was this? Oh, shit, you guessed it, Ryan Johnson. So this episode of the financial crisis of 07 and 08 brought to you by Ryan Johnson. Thanks, Ryan Johnson, for totally fucking up Star Wars and the economy. Now, these tranches of the CDO were the following. There was a senior tranche, which is the lowest risk and had the lowest rate of return because low risk, low interest. There's the mezzanine tranche, medium risk, medium rate of return. So you can be willing to take on a little bit more risk, and in order to take on that little bit of extra risk, you have to be incentivized in some way, shape, or form by getting a higher rate of return on what you get. And then there's the equity tranche. Ooh, this is the bad one. This is the highest risk, although it did have the highest rate of return. Now, these CDO classes could be rated, meaning institutional investors could buy them, meaning more customers. They've expanded the market, and they did so. And actually, assuming everybody were to play honestly in this game, it's actually a pretty genius invention. It's pretty cool, I think. So let's assume a fraction of these mortgages in the mortgage-backed security defaulted. Here's what would happen. Not every tranche would be paid out evenly. It would kind of go something like this. The senior tranche gets paid first. So as these income payments, or this stream of payments come in, senior tranche gets paid first. Once everybody in this tranche is paid, then mezzanine starts to get paid. Once they're paid, if there's anything left over, equity gets basically the leftover scraps. And the interest rates earned on these assets reflected the risk. So what if the equity tranche didn't get paid anything? Is there any way that we could ensure this to make sure, okay, if there are losses because I bought into the equity tranche and then all of a sudden I'm getting screwed because I'm not getting anything at all, even an interest rate, there's no payment coming to me. Is there any way that this could be insured? Well, the answer is yes. If you're worried about the risk of default on the lowest tranche, or even the middle tranche, hell, even the highest tranche if you were super risk averse, you could get what's known as a credit default swap, or CDS. It was insurance on the collateralized debt obligation, so it insured this risky asset purchase. It was perceived to be safer this way. It almost seemed as if it was foolproof, but shit, it wasn't. So even though they thought they could try to run the game like, well, this, where we just let future Ted and future Marshall deal with it, it didn't work out very well for them, by the way. Well, guess what? Didn't work out well for the institutional guys either, for the financial institutions. Didn't work out well for anybody. Kind of blew up in their faces. So before we get to how it blew up in their faces, let's recap a little bit. So people were taking out loans to buy a house. Commercial banks that lent them owned the mortgage. Investment banks bought massive quantities of these mortgages, and because commercial banks didn't have to bear any risk, they could use really shady lending practices. And then basically immediately sell these guys to investment banks. These mortgages were thus securitized into mortgage-backed securities that were then split into different classes, forming a collateralized debt obligation. And the classes of the CDO reflected the risk of default. And if you were really risk averse, you could get a credit default swap, which was basically just insurance on that asset in case it didn't pay out. So if any of this seems sketchy to you, well, that's because it is. It's super sketchy. You might ask yourself how it's even legal. Well, sadly, there was a lot of lax regulation put in place by the federal government, and there were two government-sponsored enterprises, Fannie Mae and Freddie Mac, who were buying a lot of these mortgages. So a lot of people stood to gain substantially from these practices. So who can we blame? Well, you guessed it, Frank Stallone. Yeah, Sylvester Stallone's younger brother. Even looks just like him. Adrian! So how did the federal government contribute? Because like I said, the story you might hear, especially from players within the federal government themselves, would be that the federal government was totally innocent, they didn't do anything wrong, and everybody just took advantage of the system. Well, that's not entirely true. Let's flash back to 1992. President George H.W. Bush signed a law requiring Fannie Mae and Freddie Mac to help facilitate financing to these low to moderate income households. The initial requirement was that 30% of all mortgages acquired by Fannie and Freddie had to be composed of low to moderate income households. 1999, President Bill Clinton wanted to increase the ratios of these loan portfolios to areas under the Community Reinvestment Act of 1977. This ultimately required Fannie and Freddie to take on more risk. They were getting riskier mortgages. Now, in 2000, there were new regulations put in place to prevent risky loans from counting towards affordable housing. Unfortunately, that was dropped in 2004. Now, if you look at the timeline of a lot of this stuff, 2004 is when this shit really began to hit the fan. Now, so we talked about the federal government, we talked about the financial institutions rather extensively. Let's talk about the Federal Reserve. So they were argued by some to have helped cause the financial crisis. The Federal Open Market Committee chairman, Alan Greenspan, who was chairman from 1987 up to 2006, was argued to have held rates too low for too long. Ben Bernanke succeeded Greenspan as FOMC chair in 2006, and he steadily began to raise rates because he knew that interest rates were, as he said, uncomfortably low. And that was in a paper he published either in 2003 or 2004 that was a theoretical paper looking at how central banks could respond to a financial crisis when interest rates are already way too low. So he kind of saw some of this coming and was like, okay, let's try to get interest rates up a little bit. Now, by Bernanke's own statements, like I just said, he and a lot of others in the Open Market Committee saw this stuff coming. There were a lot of people at the Federal Reserve, not even just on the Federal Open Market Committee, but just even some of the lower level workers knew that this stuff was coming. They could see the data, they could see the trends, and they weren't stupid. So if they saw it coming, why didn't they do anything about it? Well, sadly, the answer is kind of complicated, but there's really two main reasons they didn't intervene. So let's start with the easier one. First, the Fed, and, well, basically everybody, had no clue how systemic this problem was. They thought it would be a minor issue. Bernanke himself was even quoted as saying that he thought it would only reduce GDP growth from 2.2% down to 1.2%. So you would still have positive GDP growth, it's just it would slow a little bit. Unfortunately, it had metastasized within the entire U.S. economy, and it had sort of worked its tentacles into most major sectors of the U.S. economy, and these people just didn't really know it because there was no way to really track what was going on. So what was the second one? What's the second reason? Well, the Fed had control of one interest rate, and that was the federal funds rate, which is the overnight lending rate between banks on excess reserves. So if, say, Bank of America needs a little bit of money at the end of the day because they can't meet their reserve requirement, what they'll do is they'll call another bank, I don't know, Wells Fargo. We'll just use them. Wells Fargo has a little bit of extra reserves. So Bank of America calls Wells Fargo, goes, hey, can you lend us a little bit of money? And they go, sure. So they lend them a little bit of money. And what happens is the next day, as soon as markets open, Bank of America will liquidate some of their assets. They'll get more vault cash and then just return it to Wells Fargo. And then Wells Fargo goes, oh, hey, thanks. But by the way, we kind of lent you some money, so maybe a little bit of interest would be nice. And Bank of America's like, oh, yeah, shit, we forgot. And then they're going to give them a little bit on top of it. And it's not going to be very much because the opportunity cost of holding idle cash for like less than 12 hours is pretty much zero. It's really, really low. So whatever that opportunity cost is what the federal funds rate is. So if the Fed had raised the federal funds rate, there was a question over how it would transmit to the rest of the economy. Because remember, we were talking about interest rate channels in the new Keynesian model. Well, this is an application of the interest rate channel. If they raise the federal funds rate, it's that increase in that interest rate is going to transmit through the rest of the economy. But depending on what the transmission mechanism is, it's going to feed through in a number of different possible ways. Namely, okay, is it going to hit housing markets first? Maybe, maybe not. They don't really know. They could have some estimates. They could get a decent idea, but probably not. It was probably going to hit other stuff first. Like what? Well, anything that needs any other sort of financing. So let's say durable consumer goods. So that new refrigerator that you were wanting to get, or that new really badass custom USA-made Jackson guitar that you wanted, that you've been wanting for the last 18 years of your life, and maybe one day in the next 18 years you'll actually be able to get it. If interest rates go up, you're not going to have as much of an incentive to finance those purchases. So anything in the guitar industry or, say, just the appliances industry, they might suffer if the Fed funds rate gets raised, and they might actually suffer before the housing market does. So if you screw those sectors up first, and then the housing markets get screwed up, well, it's going to trigger a recession, and by the time it gets to housing markets, things are already going to be pretty bad. So there was debate over what this transmission mechanism was, because it probably wouldn't have immediately hit the housing market. It would have hit other markets first, helped crash them, thrown the U.S. into a recession before the housing market slowed, which would have made things even worse. So the Fed, they were pretty hands off. They slowly raised rates, but they didn't do so too drastically because they knew as soon as they did, it would trigger a recession. And they, one, wanted to push it off for as long as they could, and two, wanted the economy to be in as good of a state as humanly possible before hitting the recession. Now, around 2007, housing prices started to fall. Now, as with any bubble, as soon as the price starts to decline, the bubble begins to burst, which basically this is sort of like the prelude to the crisis. Things are starting to get kind of bad. Now, we officially entered a recession in the fourth quarter of 2007, and it just kept getting worse from there. By March of 2008, Bear Stearns ran into a lot of financial difficulties, and the United States Treasury had to bail them out. Then, in July of 2008, they bailed out Fannie Mae and Freddie Mac. Now, at the same time this was going on, Treasury Secretary Hank Paulson declined any further federal government bailouts. He basically just said, okay, look, we bailed out these guys. Nobody else is getting help. He didn't think it was going to get as bad as it did, and, oops, he was wrong. September 15th, 2008, landmark day. Lehman Brothers collapsed. This starts a global financial crisis. Eventually, Merrill Lynch went under. They got sold to Bank of America. AIG was in the hole, went to the Federal Reserve for help. The Fed ended up buying AIG. And the Fed then took another $52 billion in mortgage-backed securities. But sadly, even that didn't help. So here's the federal funds rate between 2006 and 2018. So right around here is kind of the beginning of the financial crisis. This is around the point where Bear Stearns went under, Lehman Brothers started to collapse. Oh my God. So what's going on here? Well, what happened is the federal funds rate, which is used by the Federal Reserve to control the money supply, when they lower the interest rate, the money supply goes up. So they were basically expanding liquidity in the markets in order to prevent these guys from actually going under. But when they do that, eventually interest rates hit zero. And when they hit zero, it's what's known as the zero lower bound for nominal interest rates. Real rates can go below zero, but nominal rates can't. So as soon as they hit zero, they were like, oh shit, what are we going to do? Like, there's not very much left for us to do, and we entered what's known as a liquidity trap. And no, Admiral Akbar does not approve. Oh, it's a liquidity trap. So the federal funds rate hits the zero lower bound, or ZLB, basically tying the Fed's hands when it comes to countercyclical monetary policy in this case. Now, while all this was going on, Ben Bernanke and Hank Paulson went to Congress to get them to approve a $700 billion plan to buy a lot of these mortgage-backed securities that were at risk of a default. They really wanted to buy, well, about $1 trillion worth, but they knew that Congress was not going to be okay with that many zeros behind a one, or really just behind any number of any sort. So they were like, okay, let's go for like $700 billion. They'll probably be okay with that. Sadly, Congress rejected the bailout bill. I'm sure they're really kicking themselves in the ass for that now, because a lot of them got kicked out of office for this. Washington Mutual goes under. Stock markets plummet. Dow Jones loses 700 points, and the S&P 500 index lost half of its value overnight. Basically, this is what happened in financial markets. It was very, 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 very bad. Or Laurel and Hardy. Now you've done it. Another fine mess you've gotten us into. So we could sort of think of this as like Ben Bernanke and Treasury Secretary Hank Paulson running away. We could also think of this as like, Bernie Madoff, who's trying to, have made off with all your cash. Bad joke again, I know. It's really bad. So ultimately what happened is things got really bad. People pulled their heads out of their asses. Treasury eventually bailed out a lot of these financial institutions. According to Hank Paulson, who was the Treasury Secretary, Ben Bernanke, who was the Federal Reserve Chairman at the time, and Tim Geithner, who was the president of the New York Fed, the results would have been catastrophic if the Treasury didn't do anything. The Federal Reserve also intervened. And so what we're going to do now is we're going to look at the results of the policy responses. And it would be nice to do so looking at both fiscal and monetary policy responses. There's not really enough time because, well, the semester is completely, totally over by Friday. So instead, what we're going to do is we're just going to look at the monetary policy response. Plus, like I said, monetary policy is a little bit cooler. It's faster. It's more effective. For fiscal policy, you end up having most people in Congress bicker for weeks and weeks and weeks on end. If you've been following the news with COVID, you've seen that there's been a lot of bickering in Congress trying to get certain bills through that they really should have just passed. But no, there's a lot of room for political gaming. A lot of these congressmen, well, they have to please their own constituents. So basically, there's a lot of weird self-interest going on here, albeit rational self-interest. It makes sense. But it slows the process down a lot, whereas monetary policy is very, very quick. It's effective. We hit a crisis. By the end of the day, the Fed can intervene. They can usually intervene within a couple of hours. So, okay, maybe it's a bit of a biased opinion, but I am a monetary economist, and I'm a PhD monetary economist now, so it means you have to listen to me or something. So we're going to use some of these tools. Actually, you've seen these tools before. We're going to use a VAR, and we're going to identify what the responses to a monetary policy shock are. So what was the monetary policy response? Because, like I said, they did what they could, drove interest rates down to zero. Things weren't getting better, so they had to do something else. They had to do something really drastic, and they had to do it as soon as they could. This is where quantitative easing comes in. Now, instead of toying around with short-term Treasury securities, what they did was they purchased $4.2 trillion in long-term Treasury and mortgage-backed securities. So they bought public debt, the Treasury securities, but they also bought a lot of private debt, which were these mortgage-backed securities. This was called quantitative easing. It's a form of unconventional monetary policy. The ideas were pretty simple. They wanted to increase the money base, because remember, the money base is currency plus reserves, and reserves are vault cash that banks have. So basically, carrying cash, vault cash. That's the money base. Now, the money supply is a little different, because if you've just got money chilling out as reserves, well, if that money doesn't get lent out, it doesn't enter the money supply. So the money supply is a little bit, actually, it's very different than the money base. So if we don't want that money to get lent out, because as soon as that money gets lent out, it triggers inflation. We don't want any inflation right now. Maybe a little bit, but not much. How do we try to control that? Well, the best way that we can do it is to provide a set of incentives that we can increase the money base, and then we can also make sure that the money supply doesn't change. How do we do that? Well, what they did was they first expanded reserve balances massively, as you'll see in just a few slides. They expanded reserve balances, and then in order to incentivize banks to hold on to those reserves, they paid interest on excess reserves. So whose legitimately awesome idea was this? Well, if you thought it was either Ryan Johnson or Frank Stallone, you're dead wrong, because it was Ben Bernanke, monetary Superman. The Ben Bernanke will save us all, and he actually kind of did. So here are the Federal Reserve's balance sheet trends between 2008 and 2018. If we look, this purple line, or this purple curve really, are securities. So these are the assets held by the Federal Reserve Bank. In order to finance these purchases of these securities, what they do is they generate these excess reserve balances, which basically count as liabilities on the Fed's balance sheet. So they create excess reserves to purchase these securities. So what they're doing is they're taking these existing securities that have monetary value out of the market, and basically exchange for that, they're giving money to these guys for the securities that the investment banks initially owned. So if you've got a bunch of these securities, and say you've got a couple $100 billion worth of securities, and you've got, I don't know, a few $100 million in short-term obligations that you got to pay, but you don't have any hard cash on hand, all you have are these totally illiquid assets. The Federal Reserve comes in, purchases those assets via the creation of excess reserves, and they ultimately just turn that illiquid asset into the most liquid asset possible, which is cash. So they weren't just creating money, right? The monetary value for that already existed. They just turned something that had monetary value but wasn't money into money, which of course has monetary value because it's money. And we can see over the course of 3 different rounds of these, what's now referred to large-scale asset purchases, the Fed purchased about $4.2 trillion of these securities. Now, That's a massive, massive amount of purchases. We haven't seen anything that big. Well, actually, no, that's a bullshit lie. We have seen something that big. Very recently, the Federal Reserve engaged in a basically now fourth round of large-scale asset purchases. So this is still going on. They try to make sure that they don't ever do this unless there's like a really, really, really bad situation going on. Everything leading up to the financial crisis was actually not responded to in this way. And the reason they had to respond to it in this way was because the federal funds rate was so damn low. There was nothing else they could do. So if they can't buy short-term treasury securities to affect the overnight lending rate, what they wanted to do instead was buy long-term treasury securities to affect the long-term interest rate. So instead of affecting an overnight lending rate, which transmits to like, a 1 and 3 month treasury yield, they're instead buying long-term securities, lowering the yield on long-term treasuries, like 10, 20, 30-year U.S. treasury securities. By lowering the interest rate on that, what they're doing is they're lowering the difference in the interest rate from the long term and the short term, to where instead of there being this massively stark difference where, say, the short-term interest rate is 0.25% and the long-term rate is 10%, the short-term interest rate still remains at 0.25%, but they'll lower the long-term rate down to, like, let's say 2%. So when that happens, that will stimulate real economic activity. The way it does, or at least the way that the Federal Reserve argues it did, and most of the existing research out there confirms the Federal Reserve's statements on this, is through what's known as a portfolio rebalance channel of monetary policy. When that happens, they lower the yield on these long-term government treasuries, and people that were holding those government treasuries are like, man, I don't want these things anymore, screw this. And they alter the composition or the balance of their portfolio by buying into private equity markets. So they would buy into the S&P 500, Dow Jones, stuff like that. You would then see a boost in asset markets or equity markets. And because of that, because that is considered a leading indicator of GDP, if you were to stimulate stock market activity, you'll eventually stimulate real GDP. So did quantitative easing work? Well, we can test it, thank God. We can run a statistical model. We've actually kind of already gone over this, so I don't even know why I put it in this fucking slideshow. The idea is if the real world data matches the theory's good. Well, we've already talked about this stuff. So dynamic responses, we're going to use a couple of variables here. We're going to use the log of real GDP, the log of the core PCE price index, log of securities held outright. What are securities held outright? Well, let's just back up a little bit here. That purple curve, securities. So basically assets held by the Fed. Because these securities, when they're purchased by the Fed, are equated with the creation of excess reserves, if you were to increase the Fed's holdings of securities, you are increasing excess reserves. Therefore, this is a monetary policy shock. And because it's just the other side of the balance sheet, we can use securities in lieu of a monetary aggregate. And then we also have the 10-year Treasury yield, which is the long-term interest rate. And we want to look at how these guys are going to respond over time. So let's get to it. So quick recap, monetary policy shock. It's going to suggest some monetary aggregate increases. So in this case, the money base. When the money base increases, the Fed's security holdings are going to increase. Therefore, you can use securities or you can use a monetary aggregate. Either way, the policy rate that's being used is going to fall, which triggers an increase in desired expenditures, triggering an aggregate demand shock. If prices are sticky, output has to respond. And this tends to hold for the short run, but not the long run, which is, as we discussed, monetary neutrality. So here's the monetary policy shock, where the LM curve shifts out, lowering the real interest rate. Transmits by causing an increase in aggregate demand. And in the short run, the aggregate demand curve shifts along an upward sloping aggregate supply curve, increasing prices, but also increasing output. This is the inflation output trade-off that I talked about with the Phillips curve. And here are the responses to a monetary policy shock. So when we look at this, we can see real GDP increased. Okay, that's a good thing. So let's kind of look at this a little bit further here. Okay, so we can see securities held outright, which is where the shock actually starts. It originates with this equation. I scaled everything to be a 100% increase in securities held outright. So the Fed basically doubles their holdings of securities. So as that increases, what happens? Well, first, the 10-year Treasury yield drops because they wanted to flatten the yield curve. So if we look at this and the 10-year Treasury yield drops, well, that's evidence that they flattened out the yield curve. So what is that? Well, that's this right here. So monetary aggregate increases, the real interest rate drops. Now, I know over here this is a nominal interest rate, but of course, really all we need to do is just subtract inflation from this, and that's going to give us a real interest rate. And, well, actually, we can see that if we were to convert this into real terms, it also still falls, and it does so significantly. So the interest rate is reduced, which is what we saw in that first graph. Let's think about the second graph. Well, aggregate demand shock along an upward sloping aggregate supply curve indicates the price level is going to increase and output's going to go up. Let's look here. The price level increased, output went up. So New Keynesian model suggests monetary policy shock lowers the interest rate, raises the price level, increases output, at least in the short run. And that's what we see here. So that's pretty good, actually. That's kind of cool. So we can say that quantitative easing probably worked. We can see that inflation increased, reducing threats of deflation. Output increased, long-term bond yields fell. So QE may very well have actually saved the U.S. economy. Now, we saw that it worked through changes in long-term interest rates, which transmits to what's known as a portfolio rebalancing channel that I discussed. Now, if we want to know about what channels it may or may not have operated through, aside from just a portfolio rebalance channel, well, that's going to be in another lecture, which is coming up. I know. I said there were only going to be 2 lectures, but then I kind of thought about it, and I was like, fuck it, I'm just going to give them a couple extra cool lectures to kind of wrap some of this stuff up and show you why this stuff is even used in the first place. So as we wrap this up, things were getting really bad. We were almost in another Great Depression. The Federal Reserve stepped in to save the day. The Ben Bernanke will save us all, and he actually did here. Now, to wrap up this presentation, this says nothing about whether or not the Fed should have done anything at all. We're not going to get into any sort of ethical debate about what the Fed should or should not have done here. All that I'm saying is, even though the economy didn't go into a depression, it doesn't mean everything's great. There are still some serious moral hazard and adverse selection problems that were not addressed and sadly may have actually been encouraged when the Fed used quantitative easing to save the financial markets. So ultimately, banks may not have much of an incentive to not do these bad things again. So there still needs to be a massive overhaul in the regulatory structure. But if we're going to overhaul the regulatory structure within the financial markets, it would make sense to do so in a smart way rather than a very dumb way. Because if we just make stuff stricter, well, that may or may not fix things. If you're going to make things stricter, you need to make sure that you do it in a part of the economy that's actually going to work, that is going to affect the incentives that people face when they're making decisions. If we increased regulations on lending practices or removed government guaranteed losses, for example, that could probably force banks to operate more honestly, because the way everything went leading up to the financial crisis was that it would be like if you went to a casino, I gave you $10,000 and said, go gamble it all away. Whatever you lose, I'll just give you back. So if you want to go and be super risky in your gambling, well, if you lose all $10,000, I'll just give you that $10,000 back. Well, that doesn't really give you any incentive to act in a responsible manner. You're just going to go gamble all that money away. So if I go, well, guess what? Go gamble all that money, and I don't care what happens. I don't care how risky you are. I'm not going to subsidize any of your losses. So if we remove that incentive, well, they're going to have to operate more honestly. So that would be one way. Another way would be to increase regulations if we still have government guaranteed losses, or basically subsidized losses. But when profit is maintained in a private manner and losses are public, that's a big problem, because that means these guys get to go gamble all your money away. And when they lose, as they invariably do with extremely risky behavior, all that ends up happening is, well, you're the taxpayer. You subsidize their losses because the government will just give them their losses back, and they did so with your money. That's probably not going to make you very happy. So until we find a good, honest way to address this issue, we aren't in the clear yet. And that will conclude this special lecture on the financial crisis of 2007 and 2008.